Today I'm going to do an educational video on how CPAs and financial advisors can work with clients on defined benefit plans, cash balance plans, some of the more sophisticated retirement structures. It's really meant to be kind of a high level overview of kind of how the plans work, give you an idea of, what types of clients are good fits, bad fits, pros, cons, just sort of a preliminary overview. So if you've got clients that you think might be interested in something like this, just trying to make sure you can identify them, educate them a little bit, and, go through the illustration process if need be. So we're just going to jump right into it. I think a lot of people by now probably know a bit about me, but I'm the founder of Empyrean. I used to work at PricewaterhouseCoopers. I'm a CPA by trade, used to do a lot of retirement structuring for clients. And now that's all we do is structure these plans for clients. We manage we've got about 1,300 plans that we manage, 75th fastest growing financial services company in America. Also done a lot of work in the past with other Inc. 5000 companies and Silicon Valley startups. But obviously our focus is really on DB plans and cash balance plans. Okay. Quick little disclaimer. Obviously this webinar is only for informational purposes only. Each client situation is unique. So, these plans aren't really one size fits all. We also are not financial advisors, and we don't do tax returns for clients. So, we're just trying to give you a general idea again of how these types of plans might work into a client specific tax structure. In addition to that, we'll give you some ideas if you're a financial advisor on what types of things you should be considering from an investment standpoint for these plans. Okay. Overview, we'll talk a little bit about what is a plan, how it works. We'll talk a bit about the pros and cons. Take a look at some scenarios in which these would be good for clients and some in which they're not going to be good for clients. We get a lot of people that send us clients who are not a good fit. We want to make sure we identify those up front. Few questions you can ask to pre-qualify clients. We'll talk a little bit about the investment options. We'll show you how compensation works. Whether it's net income based, W-2s, things of that nature. We'll discuss some structuring tips. Definitely want to cover a little bit about some other plans. Even though this is meant specifically for defined benefit plans, a lot of clients are going to come to you and they've already got a separate retirement plan set up. So we want to make sure that, you've got a little bit of background in, understanding what types of plans they got in place. Do they work with DB plans and so forth? Lastly, we'll reference certain resources that we have if you're looking for additional information. Okay. That being the case, let's jump right in. I first wanted to kind of go over some of the goals for advisors. When I say advisors, I'm really talking about, again, CPAs, financial advisors. Occasionally it's a tax attorney or someone that we're working with. But the key thing is we want to make sure that advisors, whatever specialty that you're in, that you have a little bit of front-end education on these. So you have a little bit of a basic understanding in how these plans work. And then also you want to be able to identify clients that are good fits. Okay. So again, first of all, understanding the basics of the DB plans are critical. Understanding how the plans work, how they're funded, how they're different from defined contribution plans. Also, how you can identify clients who might be a good fit. Be able to educate clients on the basics. I think you really need to, before you get us involved and a lot of other folks, really kind of understand what the client is looking for. Ask a few important questions of them. We'll talk about them here shortly, and make sure you can understand the basics with the clients and go over that. Once they've understand the basics and they agree, it's a good chance to get us involved. In fact, we do not set up plans unless we're actually able to talk to the client, because we want to make sure they're definitely a good fit for us. And lastly, how you would go about reviewing these with other advisors. Again, CPA might have a financial advisor that needs to be involved. Financial advisors are typically very eager to set up these plans because we've got very high AUM. Our average contributions are 150,000 plus. So advisors really like them, but obviously CPAs want to understand and feel comfortable with how these plans work. Most CPAs out there know these plans exist, but they don't understand a lot about them. And so sometimes if you're an advisor watching this, you may say, hey, this is a great plan, but you go to the CPA and the CPA says, no, I don't understand this, or this doesn't make any sense, or, I don't want to do this. You'll find very often that the CPAs are the gatekeepers for a lot of clients, and CPAs can put the slam on the brakes on these plans from time to time. So we want to make sure you understand, enough so that you can discuss these with other clients or other advisors involved in the process, in addition to the client themselves. Okay. So the first step, we'll talk a little bit about what is a defined benefit plan. Okay. So I'm going to cover a broad category of things here with respect to these plans. First of all, there's two types of retirement plan structures, two broad categories. One is a defined benefit plan, and one is a defined contribution plan. Most people watching this are very familiar with defined contribution plans. These are like SEPs, 401ks. There is a defined amount that you can put in to a plan each year. It's often indexed annually by the IRS. And once you put that money into the plan, assuming you qualify, it doesn't matter if the assets go up or down. You take the tax deduction in the current year, but the ending investment balance does not play into future contributions. Remember, it's a year-to-year thing. You've got a limit. For example, you might have $23,000 on a 401k. That's going to go up, $500 a year. Assuming you've got income of at least that, and you're self-employed, of course, you can make that contribution. Again, doesn't matter if the investment, that 23 grand goes to $1 million, or let's say you invest in a stock of a company, it goes bankrupt, goes to zero. Does not matter, does not impact subsequent year contributions, okay? These are defined contribution accounts, defined contribution plans, excuse me. Very simple to administer and rather easy. Now, the second category is defined benefit plans, okay? And of course, that's what we're going to talk mostly about. Now, defined benefit plan defines a future benefit. We'll talk a little bit more about it, but we can get in as much as $3.5 million into these plans. So you can make very large contributions. Again, our average contributions are probably $150,000 plus. So you can get very large contributions to these plans. But because it's a defined benefit down the road, every dollar you put in today is one less dollar that you can contribute into the future, okay? The ending balance, the asset returns, all those types of things will tie into this benefit, because essentially if you've got a benefit, let's just say, for example, of 3.5 million, our actuaries are going to look and say, is the amount in the plan today, based on your age and income, is that amount enough from a present value standpoint to cover this future benefit? Do we have enough set aside to cover this benefit that we're going to need to meet 10, 20 years down the road? And that's all the actuaries are doing, is make sure you've got enough pursuant to the plan document, okay? These plans are driven largely by age and compensation. Compensation caps out in 2025 at $350,000. Typically, if you're going to do a solo plan, you'll cap out around 280 grand. But needless to say, the higher the contribution, the more that you can get into a plan. Also, they're driven a lot by age. Younger people will not be able to get as much in. A 30-year-old, I'm 57, 30-year-old can get in about a third of what I can get in at my age. So I get a lot more bang for the buck just because I'm much closer to retirement. And so I'm much closer to earning that benefit. So the company has to make a larger contribution for me. Okay. So good thing to know is if you've got a young business owner, 30-year-old, probably not going to work unless they've got some very high income. But if you've got a 60-year-old who really wants to put some money away, obviously the 60-year-old is going to be a much better candidate. So think about the age and the compensation. We'll talk a little bit more about good fit and bad fit, but that's the primary driver. Remember, these plans allow for very large contributions. Your 401ks are going to cap out in the 70K range. It's not unusual for us to see contributions of $500,000 plus, especially as someone gets older with higher compensation. Okay. these plans, a good thing to remember is these plans are similar to Social Security. I like to bring that up because how does Social Security work? You work all your life, you make contributions in via the payroll taxes. And once you get to a point when you retire, the IRS or the government says, hey, we're going to give you X amount, $2,000, $3,000 a month, whatever it is for the rest of your life. Okay. That's basically a defined benefit plan. Okay. And that's what we're doing for our businesses. Okay. We're putting a contribution amount that's going to qualify for an annual payment at retirement. Okay. But rather than having a payment of $2,000, $3,000, I think IRS might cap around $4,000 monthly, give or take. With these plans, you can get in, over, $200,000 a year of actual deductions or amounts that you can take out of it. So the benefits are substantially higher. Because the benefits are substantially higher, your contributions can be much higher. With higher contributions comes higher tax deductions, and that's primarily the driver for a lot of these. But the reality, though, is this is just like Social Security, one big difference. Social Security, you can't call the IRS or the Treasury Department today and say you want to opt out, you want a lump sum payment. With a defined benefit plan, you can. So assuming, you meet some of the plan rules, maybe you're going to retire at age 60, you've got $1 million in, rather than taking an annuity stream on these plans, on the DB plans, you can take a lump sum amount of $1 million and roll it over into an IRA. Okay. So it's set up like Social Security to give you a payment stream at retirement, but you have the election to terminate and roll over to an IRA. If you do that, it's a tax-free transaction. Obviously, it'll be taxable when it comes out of the IRA. Okay. Don't want people to lose sight of that, because some people really have a tough time with the complexity, and they are tough to understand. But again, remember, Social Security is a plan that's in place for a lot of people. So don't lose sight of some of the similarities. Combination rules. Many plans, many other retirement plan structures that are out there do combine with defined benefit plans, but many don't. In fact, many are prohibited, but some are at least limited. We're going to talk a little bit about that as I go over some basic rules on other retirement plan structures. DB plan versus cash balance plan. Just wanted to make a note of this. A lot of people will come to us and say, hey, I want a defined benefit plan, or hey, I want a cash balance plan. We typically speak the terminology that the client speaks. If they say DB, we'll go down that route. If they say cash balance, then we'll refer to everything as cash balance. But the reality is that a cash balance plan is a type of defined benefit plan. It presents itself a little bit more like a 401k, sometimes because of the interest or the pay credits. It gives you a little bit more flexibility in funding as opposed to a traditional defined benefit plan. I'm not going to get into some of the nuanced differences of these plans, but just understand as an advisor, if someone comes to you and says, I want a DB plan, defined benefit plan, or a cash balance plan, you might say you need a defined benefit plan. They might say they want a cash balance plan. As a general rule, you're speaking the same thing. We run some scenarios to see what's best with most clients, but in the vast majority of situations, we do cash balance plans. Okay. I noted earlier that $3.5 million is the maximum that you can get in. That is the maximum amount that you can have at age 62 or 65. Realize that that is indexed for inflation every year. So it goes up about, on average, probably $100,000 a year. So if you're 40 years old and you're thinking about setting up a plan, your amount at retirement might not be 3.5 million. It might be something more like, what's the math there? 5.5 million, something like that. Now you got to qualify for that 3.5 or 5.5 million. So that's a different story. But the moral of the story is you can get very large contributions in. People will talk a little bit about those maximums. And we've written a lot of good articles on that as well. That we'll be able to give you kind of as resources, okay? But 3.5 million is the maximum. Remember the fee structures on these things, and I've also listed this out as a con. These plans are going to be a little bit more expensive. Depending on the plan design, a solo plan might cost you, $1,700, $2,000 a year to administer. You do get a tax deduction for that. So most of our clients are in a 40% tax bracket. So you can take a 40% discount right off of that, basically. But they will cost you a little bit more to set up, and clients need to understand that upfront, that they're going to pay an administrator. You know, they're paying us to do all the compliance work, to file everything with the paperwork, to give them funding numbers, to give them actuary certifications, and to keep them out of trouble with the IRS. That's essentially our job, and that's why these things cost a little bit more. The fees, I will tell you, are usually not that big of a deal if people are getting very large contributions in. If they're only getting an incremental 20 grand in over what they would do on a 401k, it certainly might not make a lot of sense under that scenario. But again, fees are going to be a little bit higher, and it's very important to mention that to the clients up front, that there's going to be someone like us involved. 6% rule. Most financial advisors don't understand this. A lot of advisors think that we can just take a 401k or a SEP and a DB plan and just kind of layer them all on top of each other and make a gigantic contribution. Not true. 90% of our plans combine with a 401k plan. You can do the deferral without restriction because that is an employee participant deferral, but the profit sharing is going to be 6% of that W-2 amount. So typically for most advisors and CPAs, you understand that a solo 401k has a profit sharing, which is 25% of the W-2 or 20% of the sole proprietor income. But when it comes to these plans, it's going to be 6% of the W-2. And we have to kind of back into that 6% contribution. It's close enough. It's the difference between the business net income and the contribution to the plan. But needless to say, the 6% rule is pretty important. I recommend that advisors and CPAs understand this, because a lot of times they'll tell clients, just go out and fund 25% in your 401k, and maybe we'll do a defined benefit plan later. You'll find that you won't be able to do that unless it's a mega maybe, but you won't be able to do that in many situations. Or you'll have to take the money out or whatnot. So again, something important for you guys to consider there. All right. Moving on, pros and cons of the plans. Okay. First of all, the pros, I think you're well aware of them. Very large tax deductible contributions. Average is around 150. Not unusual for someone. Our typical clients around age 50. A 50-year-old can get typically $150,000 to $200,000 into a combined 401k defined benefit plan. Okay, very large contributions, fully tax deductible. In addition to that, they do receive flexible funding ranges. Now, every year when you have a DB plan, you don't get, here's the exact number. You got to put $142,000 into the plan exactly. No, you're going to get a range. Might be $100,000 on the minimum, 142 on a target, and 200 on a maximum. So you've got $100,000 range in there to deal with. Also, if you were short on cash in that given year, you could not do your 401k because your 401k and your profit sharing are elective. So people think they're kind of tied into something, and they're really not. We can make these ranges somewhat flexible, okay? So that's going to be one advantage. Remember, the third advantage is that when you don't want this plan, you can roll it over into an IRA, 401k, or another qualified plan like a SEP, okay? So you don't have to necessarily have the plan forever. You can roll it over in a tax-free rollover and then pay taxes when you take it out of those qualified plans, okay? Three big pros. Cons, when I talk to clients, I go over the pros and the cons, and I especially hit on the cons. The pros take care of themselves. If you're a good fit, the pros are very simple. The cons, you want to make sure they understand. First of all, these are permanent plans, okay? Permanency does not mean you have to have the plan forever. It means you should go into these plans with long-term intent. Hey, I'm going to have this plan for the rest of my life. I'm 40 years old. I'm going to have it for 22 years. I'm going to retire. I'm going to take an annuity stream, and everything's wonderful. But when something changes in your life, your business dries up, it goes away, you take another job, whatever it might be, and 10 years down the road, you don't want or need the plan anymore, assuming it's a business requirement, as a general rule, you're fine, okay? But the plan permanency rules mean you want to go into it with long-term intent. Typically, if you have it for a few years, you're okay. But just don't go into this thinking, hey, I'm going to fund this thing 1 year, and next year, I don't know, or maybe I'll skip a year. No, they're permanent plans. You got to pay us every year for annual administration while they're open. And you want to make sure you consider them for the long term, even though, typically a 3-year minimum will get you there. Okay. Second of all, mandatory contributions. We just talked about how 401ks are elective. They're optional. You do not have to do them. These plans, as a general rule, will have mandatory contributions. Sometimes they're not required if your plan is overfunded, but as a general rule, you're going to have mandatory contributions. So make sure you've got some money set aside. How much are the contributions? It depends. There's a variety of things that we can do to structure these things to keep that mandatory very low. Certainly, if you have any issues or questions, let us know. But we can structure them with lower mandatory contributions, but typically it might be at least in the $50,000 range, again, depending on age and income. Again, these plans aren't for people who just want to put 20 to 30,000 into retirement. They're for people with good incomes and long-term strategies. So remember, they have to make a commitment to funding. Also, like I discussed, they do have higher plan administration fees. Group plans can cost you, $3,000, $4,000, $5,000 a year to administer, which again, I think is great if you're in a high tax situation and you can make high contributions. But again, want to make sure that clients are aware of the fees. Usually that's not that big of a deal breaker, assuming that they can get the large contributions in. Okay. Who's a good fit? Let's talk about some good candidates. First of all, solo professional. Someone who works alone or possibly a husband and wife, CPA, law firm. Maybe it's an actuary. Maybe it's an engineering firm, a physician, a chiropractor, dentist, those types of folks. A lot of professionals, solo professionals, it's great for them. Our typical client has probably 500 to 700,000 in income. You've got a lot of physicians out there doing locums work. They're great candidates for these plans. Much easier. There's not a lot of cross-testing that's involved. You don't have a lot of employees. Solo professionals are always great. Also, professionals with 2 to 10 employees. Now, I just mentioned dentists as solo professionals. Most of our dentists, might be like endodontists who are sort of hired guns for other firms or other companies that come into a dental office, or maybe an oral surgeon. But if you're a dentist and you've got 5 or 10 employees, plan can work well, assuming you make high income. Maybe you're in a high taxing state like California. Probably a third of our plans are in California. Also, if you're older and if you've got some age and income disparity, i.e. your income, your W-2 is high, and you're in your 50s maybe, but you've got employees that make 30, 40, 50 grand a year and in their 30s. You've got a lot of disparity between those two. That can help out a lot. Okay. Also, older clients, we mentioned earlier. Older people in their 50s, 60s, 70s are going to be able to get much larger contributions than people in their 30s and 40s. Doesn't mean that a plan won't work for someone 30s or 40s, but it really, it's kind of one strike against them. If they're 30s and 40s, but maybe their income is only 300 grand, that's not going to work as well as someone who's 60 and has income of 300 grand. Okay. Just because they can't get in as much and the relative benefit won't be as high, still can make sense for it. So look for people who are generally older. How old is old? Mid 40s, the numbers start looking a little better. Like I said, the majority of our clients are probably age 50 is probably a good average. Once we get into our 50s, we're kind of in our peak earnings years. In addition to that, we've got a lot of other bills paid off, maybe kids, in college, getting out of college, maybe house paid off, things like that, where we can stash away a little bit more money. Okay. Consistent income. Not only is high income important, consistent income is important. Doesn't mean that if you have, good income one year and bad income the next, it can't work for you. But, if you made $500,000 consistently every year, you could kind of map out your contributions. But let's say you were a real estate agent, or you were, we have clients who will be like litigation attorneys where they might get a really big settlement one year and not so much the next. You really have to look out and you really have to decide, if your income is consistent where you're just like, I have no idea how much money I'm going to make. I don't know next year if I'm going to make 100 grand or $1 million. Well, that can make your planning a lot tougher. It makes your tax planning a lot tougher. So doesn't mean to say a plan won't work for you, but those are the things you want to take a look. And usually I'll tell a client, look out over the next 5 years. I know we don't have a crystal ball, but if you look at your situation over 5 years, are you going to have some higher earning years? Are you going to have some $300,000, $400,000, $500,000 years? How many $100,000 years are you going to have? Look at the totality of it kind of as a crystal ball and see if you might not get a lot of utilization out of it for a year or two, but you might find out of 5 years, you might get some very high contributions for 3 out of 5, and that could make a lot of sense for you. All right. When it comes to income, there's really no minimum, but I think I would tend to say 300,000 plus. 200,000 can work for someone who is 60s maybe and really, really wants to get a lot in, but generally speaking, 300,000 plus of net income. High tax brackets. Definitely someone who lives in California, makes $1 million a year where they're looking at a 14% state tax rate. It makes a little bit more economic sense for them compared to someone who has a, excuse me, someone who is in Florida with no income tax, okay? High tax brackets are great. Also, what we might find from time to time is we might find someone who, they have a spouse who's a physician. Maybe they make 600,000, 700,000, 800,000, live in California, have a very high tax rate. Well, maybe they personally just have a lower business. Maybe they do, I don't know, they do some sort of IT consulting, and maybe they make $200,000 a year, which as a general rule isn't great for these plans. But because their spouse's income is so high, they don't need any of this money to live off of. They're also in a very high tax bracket. So maybe they can stash a couple 100,000 away. And it's pretty easy if you make 200 grand to maybe stash about 150 away in a combo plan with a defined benefit plan and a 401k, depending a bit on your age. That would be true if your age is kind of mid 50s plus, generally speaking. Okay. They're also pretty good as payroll tax plays. Remember, by law, you're supposed to pay yourself a reasonable wage for the work that you do. Every $10,000 of compensation you pay yourself costs you about $1,500 in payroll taxes. You don't get to deduct half of that. So when you factor in, our fees, if it allows you to reduce payroll taxes a little bit, it usually can be a pretty good offset for you. Typically, payroll tax plays are a little bit more relevant for people at lower income levels, 200,000 to 300,000. But again, if you've got someone who's really strategic and is really looking at this and, understands reasonable compensation rules and so forth, they can really strategize it out to where the payroll tax savings that they're going to get is more than going to offset the fees. And again, they can write our fees off in addition. Okay. So that makes a lot of sense. Also, likely good candidate is someone earning or someone looking to contribute over 100,000. Again, they want to get 20, 30 grand in, stick with the SEP 401k. Probably a 401k would make more sense because it's easily, they can kind of graduate that up into a DB plan if they want to. But again, that's the type of thing you're going to want to pay attention to, is people who are really looking to get those contributions. It can make sense for someone who wants to do 75 grand, but around 70 is your max on your 401k. So it just really depends on that situation. So typically 6-figure contributions are good fits for us. Okay. Now let's talk a little bit about who are bad fits. Income, like I said, if your income's less than 200, probably not a good fit unless you're in your 60s plus, and you really want to sock away as much as in retirement as possible. Can make sense. Anybody with a lot of employees, I said 10 plus employees. Again, really depends. There are situations where someone might have 5 employees and we're going to say this isn't going to work. But if you've got 10, 20, 30, 50, 100 employees, typically going to be a little bit more challenging to do something like that, just because you have to have a meaningful benefit for any eligible participants. You've got to have a meaningful benefit. You've got to pass a variety of other tests when it comes to profit sharing contributions and things like that. So it just means you're not going to get as favorable of a contribution to the owner. So be very careful. I wouldn't present someone with 15 employees to us unless, they're making 500,000, 600,000, 700,000 a year. They're at least 50 years of age. They're in a high taxing state, some of those types of things. Then it can make sense. But again, probably not the best scenario for you if you're out there looking for clients. Also, people in low tax brackets. Occasionally I get people come to me and they say, hey, I want to get my tax bracket as low as possible, and I want to get it down to here, and I don't want to pay any tax. And look, my 2 cents is, personally, I'm glad paying tax all day long at, lower rates, 20%, 30%, whatever it might be. As you start getting up in the 40, 50%, we see people in, city of Portland, California, things like that are paying over 50%. So you want to knock down your taxes when you're in a very high bracket. If you're paying 15 to 20%, you want to pay those rates all day long. Usually a DB plan does not make a lot of sense. But again, something to consider. Generally I wouldn't ask a client what their tax bracket is because they're really not going to know. They're going to tell you it's really high, whatever it is. But in reality, we all know, or people that deal with a lot of high income taxpayers, 20% is not a high bracket. Okay. So low brackets generally won't be great fits. Also blue collar industries. It's not a big knock on the blue collar industries. It's just typically blue collar industries will have more employees and less income. They won't make as much as a business as, say, a dentist would. Dentist might make $500,000 a year, but if you've got a situation where you've got someone who owns an auto body shop or an auto mechanic, maybe they've got 10 employees, maybe they have a restaurant, maybe they have an air conditioning repair business. I saw one of these a couple of weeks ago. They're not generally going to work because they've got a lot more employees relative to just the owner. So you're going to get a higher contribution to the employees relative to the owner. In general, the income is going to be a little bit lower, and often reasonable comp is going to be a little bit lower, which means lower contributions and lower income to absorb the higher contributions. But another big thing to consider is we're not going to talk a lot about PBGC, but PBGC is the public entity that it's the insurance for pensions where you have to pay into it if you're not exempt. And exemptions are mostly for professionals, doctors, lawyers, CPAs, but blue collar industries are not exempt. So it's going to cost you an extra $1,000 a year plus just to administer the plan and save those fees. So again, a dentist is going to get a lot more bang for the buck than an air conditioner repairman. So generally those really aren't going to work. I had someone recently that they owned a cement business and they had, 20 employees. And of course I got concerned, but when I found out their income was about $2 million a year profit, obviously, and the guys are very old, much older, they're going to have presumably some turnover. That type of situation might work, even though they've got a lot of employees. So it just depends. Trying to give you some general rules here. Again, we've talked a bit about young owners. Be careful. That generally speaking, if they've got other employees that are older than them, generally it will not work. If it's a solo plan, just a solo anesthesiologist at 35 years old, certainly could work. Okay. Talked a bit about volatile income. If you've got dramatic income swings up or down, plan might not work. Really depends on what those swings are. If you're going from 200,000 to $1 million and then back down to 200,000, that might make sense because you've got that big $1 million year. But if you might have a loss this year, next year make 300, next year make 50, I don't know. That might be a little tough. We see that type of thing with a lot of real estate agents out there. Okay. Also, there's some clients that just don't like complexity. I hear that from clients every now and then. Hey, Paul, this sounds great. I'm sure it's a great strategy. I don't understand it. My CPA doesn't understand it. My financial advisor doesn't understand it. Look, I want to keep things very, very vanilla, very simple, easy. I don't like a lot of complexity. Fine. That's a perfect reason to not have a plan set up with them because these plans are complex. They need to understand the rules. They need to understand the deadlines. They need to understand funding amounts. And if they don't have the capacity to be able to handle that, doesn't make a lot of sense. Okay. And I think you'll know your clients, obviously their situation, if they're kind of challenging to deal with, or they might not like something like this from a complexity, definitely someone you could screen out. Again, contributions, they're looking for something less than 75 grand, typically doesn't work, again, unless they're older and maybe have lower income and looking to get a big chunk of money in. Okay. Most important questions to ask. I have two questions that I think are the most important questions as a financial advisor and a CPA, especially as a financial advisor, because a lot of times the advisors don't know the client's taxable income. They know they're high income or they think it's about this, but they don't really know their entire situation. CPA understands the situation a lot more, and the CPA can do a lot more detailed review. But two most important questions, and then we'll go over the third. How much is your business net profit? How much is your net profit? And I say profit on a Schedule C as a sole proprietor, or profit before retirement and W-2 for an S Corp. So let's say I make $500,000. Let's say I got $100,000 of expenses. I got a $400,000 profit. This is for an S Corp. And then I pay myself $200,000 on a W-2. Well, my profit might be 200 grand because I get to deduct that out. But you want to add back your compensation. And so when I add back my compensation, I'm really personally making 400,000. 200 is coming in the form of a W-2, and 200 is in the form as as flow through income, distribution, whatever you want to call it. So, the $400,000 is really the amount we're talking about. So I got $400,000 to play with. Next, what is my total retirement contribution? Don't look at just for the DB plan, because a lot of people will say, well, I'm going to do my 401k deferral, plus I'm also going to do a 25% contribution on that. And so therefore, I only want to get an extra $100,000 in on the DB. Remember, there's the 6% rule. So, they can't do the 25% there. So the key thing is kind of what type of plan are you currently funding? What's the total you want to get in? Once you understand that, you can sort of back into the defined benefit plan contribution. So what is the total amount you want to get into retirement? We can break out the different buckets and tell you. Also, as a side note here, the maximum amount is a bad answer. People say this all the time. I want to get in the maximum. And I say, okay, so $600,000? Oh, no, I don't want to get in that much. Well, then obviously you don't want to get in the maximum. So a lot of clients will say, I don't know what I want to get in. Well, give us a rough idea. Give us a starting point. Are we talking about 50 grand? Are we talking about 100? Are you talking about 200? Are you talking about 400? Give us an idea, a starting point, and then you can kind of massage the numbers and work through an illustration to kind of back into it, okay? So definitely try to pin your clients down on a number of total retirement that's between DB and 401k that they're thinking about doing, and then you can adjust that range up or down depending on some numbers. Last comments, questions I ask. Again, sometimes I'll ask what type of plan do you currently have, but can you commit to a plan for several years? I mean, is this, you'd be working in this business for a while. Is your income going to be this high for a while? What's your motivation going forward? Is this something you feel you can do? Then that's going to make sense. If they say, I don't know, a wishy-washy client is not the best for these plans, again, because they're very complex, okay? And so trying to get them to mentally at least commit to something for several years. Now, if their situation changes and the business goes under, there's no law or penalties or anything like that precluding them from terminating a plan, 6 months down the road. I mean, we rarely see it, but again, situations change, circumstances change. See if it's something that they can commit to for several years down the road. Okay. Investment allocations. This is one of the things that's very important because a lot of financial advisors don't understand this. CPAs don't understand it, but it's really not their job so much to understand it. But these plans, because they're actuarially determined, and if you guys understand what an actuary is, again, they're trying to determine sort of a present value of a specific amount that you should have based on your inputs of your age, your W-2s and all that. What is this specific amount that you should have in your retirement plan as of the end of the year? And we're going to project that out to this benefit at retirement and see if the present amount is enough to cover this future benefit. So we have to use discounting and a variety of other things. Discount rates, variety of safe harbor rates that you can use, but generally speaking, it's going to be, around 5%. Okay. So people say, well, I hear that I have to have conservative investments. Well, not necessarily. You can have this all in NVIDIA stock or Bitcoin or something like this, but we highly recommend that you do not. We highly recommend that you mimic the 5%. Again, as of the time of this recording, CDs in the 4 to 5% are achievable. But realistically, if you get 0 to 10%, you're okay with these plans, okay? But you do want to minimize volatility, but 0 to 10% will, you won't notice a difference on the contribution ranges, okay? A lot of financial advisors will get them involved in a plan, and then they maybe get a 20% return in the stock market, and they say to your client, hey, awesome client, look, I did 20% on your DB plan. And then they give us numbers to go through and get funding pulled together. Once the funding is all pulled together, they think they can put 200,000 in, and we tell them, no, you can only put 100. And they say, well, why only 100? The last couple of years, I've always done 200. Well, because your assets grew at 20%, and our estimates were all based on 5%. So when you've got a disconnect like that, it's going to make it a little bit more challenging. So generally, you want to mimic the 5%. If you want to put this stuff in NVIDIA stock, go right ahead. Just understand that volatility will be gauged at the end of the year, and you better have some deep pockets. So if NVIDIA goes way down, you're going to put more in. NVIDIA goes way up, you're going to put less in, okay? Large plan losses, again, equal higher funding. Large plan gains equals lower funding. So bottom line, minimize generally your stock holdings, review for any stock losses, and make sure you've got heavy stock exposure in 401ks and IRAs. Financial advisors obviously will take a look at a client's pool of money. You want to say, look, the IRAs, we want to be aggressive in these, depending on the age, but we want to be more aggressive on IRAs and 401ks. Keep this conservative. You might need to look at investments in those other plans. Maybe there are some bond funds in there. Maybe you want to take the bond funds out of the IRA 401k, move them over to the DB plan, and put your NVIDIA over here where it's not subject to the volatility fluctuations that will truly impact your plan contributions, okay? Hopefully that makes sense. Very important. I've been on some very sensitive calls with clients where their investment advisors have lost them a lot of money in these plans or made up a lot of money, and that's resulted in a lot of issues in their funding, okay? So great thing for you to understand up front, especially if you're a financial advisor watching this, okay? How does compensation work? For a sole proprietor, if you're a sole proprietor on Schedule C or a partnership, well, let's talk about sole proprietors first. You're reporting Schedule C. All we need is your Schedule C profit. We will back into what we call a deemed compensation. We will back into that amount, okay? If you've got a partnership, you're going to get a K1, okay? And we're going to use that K1 to back into what your contribution is going to be. So that's how compensation works, okay? For an S Corp or a C Corp, all we really need are the W-2s, okay? S Corps and C Corps, we don't even care about your business net income. Clients will come to us and they'll say, a financial advisor, hey, my guy's got an S Corp and his S Corp makes $500,000 a year. Well, really, we don't care. What we care about is what is their W-2. Their business profit's 500, but their W-2 is 30, well, then we got a problem. We do kind of indirectly want to know their business profit because we want to understand that they've got enough income there to be able to make the contribution. We generally don't like losses. We don't care so much, but a lot of CPAs don't because there can be basis limitations. So the moral of the story is we want W-2, we want W-2 compensation, and we want it to be high enough for both C and S Corps. For sole proprietors and partnerships, we need the net income. But a key thing for you to note is that $300,000 in net income on a Schedule C is not the same as $300,000 W-2 for an S Corp, okay? Typically, you're going to need a sole proprietor that has twice as much to get a similar contribution, around twice as much, twice what the W-2 was. So if you got a W-2 of 200, that might equate to a $400,000 of net income. It depends. It depends on age, a variety of criteria. But the max compensation you'll see down here is $350,000 on a W-2 or with business income around 600. That 600 is usually someone in their 50s and 60s. But if you've got someone in their 30s and 40s, usually a max Schedule C will max out, $400,000 to $500,000 range, something like that. Okay. So trying to understand, from a sole proprietor standpoint, the net income can be a little bit challenging. But again, a lot of our clients, about 75% are already S Corps. So W-2s are really key for us. But that just gives you an idea. Those are what we need. We want high sole proprietor income and high S Corps. Remember that your sole proprietor net income, or should I say payroll taxes, will cap at $175,000 for Social Security tax. So if you go from 175 up to 350, you're just paying Medicare. So you get much higher contribution, much more bang for the buck when you go down that road. Okay. Moving on, DB plan contributions. This is a nice slide for you to keep an eye on. If you come across a candidate 3 months from now and you're like, you know what, Paul was saying something about contribution ranges. These are going to be general contribution amounts based on ages and income. Remember, this is just for illustration purposes. These aren't supposed to be precise. Actual funding can vary, depending on a lot of things. There can be prior service. There can be a variety of things that can be done. But as a general rule, if you've got, for example, a 50-year-old and they've got a W-2 of $200,000, well, you can take 71% of that W-2. There you go. They can get $142,000 into the DB plan as a general rule, up to the maximum of $195,000. This is mostly for first-year plans, for first-year clients, okay? Again, just general ideas of what they can do. If that same 70-year-old makes $100,000 a year, take that $100,000 and multiply it times 39%, and that will give you, $39,000 is what they can do, okay? So use that contribution percent for sole proprietors and for W-2s and the caps. Again, this is just a general idea. If you run these numbers, that'll give you a ballpark to maybe discuss a little bit more with the client. But in that example with that guy who's 50 and he can get 142 in, very good chance we might be able to get 200,000 into the plan, okay? Or maybe they only want to get 125 in, okay? So again, just kind of an idea to give you a number range. When you ask that client, what is the total amount that you want to do? You can then go back in and say, okay, they got a 401k, so they can do the 401k, they can do the 6%, and they can do the number off this table. Are we in the ballpark? Great. Let's get an illustration done. Let's set up a call with Empyrean, to see if we need to proceed and kind of formally review an illustration. Okay. Other retirement plans. Again, the purpose of this is not to cover any and all retirement plans, but you want to have a good general idea. I'm amazed at how many financial advisors and CPAs really know nothing about retirement plans, or they just do SEPs, because in the olden days, you could open those things up late. So we're going to touch base on these very quickly. Remember, DB plans either prohibit these contributions to these other plans, or they limit them, okay? Traditional IRAs or Roth IRAs. Most of our clients, as you're aware, there's limits, in the mid-low 200s on these plans. So most of the time they can't do a traditional IRA. They may be able to do a traditional, but it's going to be a non-deductible amount. Second of all, there's Roth phase outs. Usually in the low 200s, they cannot make a contribution to a Roth IRA. So generally not going to be able to do a Roth, can possibly do a traditional, but it's going to be non-deductible. Very rarely do we see clients, because of the high income stream that we've got, most of our clients, where they're contributing to both. Simple IRAs. I see this a lot. Clients go out and they get a financial advisor, has a dental office, or I saw this with a dermatologist recently that made $500,000 a year. The financial advisor had set the client up with a simple. Simples are horrible plans. They're not always horrible. They can be good in certain situations. Remember that auto body guy who's got 10 employees, maybe they make 50 grand a year. Maybe the guy makes 200 grand. A simple can work decent in a situation like that, because the administration is rather, there's not a lot of administration involved, and they don't need to make very large contributions because their income isn't that high. One big problem with simples, they cannot be combined with any other strategies. So I had a client specifically, true situation. They came to us and they came last year, but they're right at the end of the year. We couldn't help them out in December. They had a simple, reached back out in late January, and they said that they had made some contributions to the simple, or they thought they made them. They said, you better make sure you review that, because if you make a contribution to a simple, even $1, you cannot make a contribution to a DB plan at all. So even a $1 contribution to a simple will disallow everything on a DB plan. So be very careful. If you're an advisor and you're setting up a client who's a medical professional or law firm, and you think, not today, it's not good for them, but you think somewhere down the road that a DB plan is going to work for them. Get them in a 401k plan right out of the gate, because that way, even though it's a little bit more administration for them, that will give them the ability to do a DB plan future. Okay. Don't start off with a simple, unless you see this as a client that's not growing their income. They're an auto body shop. They make a couple $100,000 a year. It's going to vary 50 grand, but it's not like it's going to double overnight. Okay. Be very careful with that. Also, next one is SEPs. Two types of SEPs. There's a non-model SEP and a model SEP. Model SEP used Form 5305 with the IRS. If you used it and you set it up with that, again, like a simple, cannot be combined at all. You put $1 in there, you can't do any other retirement, a qualified retirement plan. It's right there in the instructions to Form 5305, okay? Non-model SEPs are basically custom plan documents. When you've got a non-model SEP, you actually can make contributions still to a DB plan, but remember, you're subject to the 6% rule. Non-model SEPs do not work well for clients who, this is their sole job or something like this. They do work reasonably well for if you've got a physician that works at a hospital, but on the side does locums work. Well, they're already getting their deferral at their job. They can set up a non-model SEP, get the 6% in, which is what they could do with the 401k, but they don't have to pay for $5,500. So the administration's a lot easier. Okay. So, but in most situations, you want to stay away from SEPs. 401k plans are great. Like I said, 90% of the time, our plans are combined with 401k plans. Deferral is unlimited. 6% is going to be the restriction on the profit sharing. Be careful with someone's got a day job 401k. Most people are aware that the employee deferral is per person per employee, per person per year, excuse me. So kind of like I touched base on, if they've got a W-2, if they've got a 401k, at their day job and they're doing the deferral, then they can only do the profit sharing, possibly the mega with their side business. So be very careful with that. That also ties into 403Bs, thrift savings plans, which are TSPs, 457 plans. Those are mostly deferred or defined contribution plans. And because of that, there are some rules. So for example, 403B plans, when they combine with a solo 401k, it's as if you've got one big plan, okay? And that can be very challenging, where a 457 is two separate plans. So be very careful on the other retirement plan rules. That can be tougher for financial advisors and CPAs, because most of them don't understand the intricacies of some of these plans. In fact, 403Bs and TSPs, because they just don't see them a lot. But if you come across them, you might want to reach out to us, and we have a few articles out there. In fact, if you come across someone, Google, 403B plan combined with defined benefit plan, Empyrean. Just put us in there. We've done articles on all these. You'll see we'll be kind of top of the search engine results. Okay. But again, just want to touch base on those just to give you some general information. Hopefully that's helpful, at least with other clients, even if they're not interested in these plans. Okay. And lastly, we've got some other resources. We've got other videos on this channel that'll help you out a lot, that'll understand funding ranges, combining plans, things like that. And if you go to our website at the top, there is an FAQ section where we craft a lot of these. If you have interested in this, if you have interested in getting an illustration or talking to us, we'll have a link below this video so you can reach out and we can run an illustration for you. Also go to our website. There's a lot of information there. You can sign up for forms, webinars. We do a lot of tax structuring, all types of stuff. We're all about educating our clients and other folks on how they can use a lot of these plans and structures to their benefit. So hopefully that was a good educational session for a lot of folks there. Hopefully that'll give you some background so you can kind of pre-screen a lot of your clients, identify ones that'll make good fits. And then if you think they're a good fit, reach out to us and we can schedule a call with them and review this. So again, hopefully you enjoyed this, learned a lot. Reach out to us if you need any help, and enjoy the rest of your day. Bye-bye.